Let's now take you to the massive swing in the financial markets this week, some of the most volatile in history. Now, of course, it's all about Donald Trump, tariffs, and China's response. And, of course, it's not just the stock market, but currencies, commodities, and bonds that also gyrated. Now, those bonds are most important. With America's massive deficits and therefore debts, somebody has to fund them. And China has been one of the biggest funders. As stock markets fall, bond markets normally rise as money goes for safety and therefore interest rates fall. But not this time. US bond rates actually rose. In other words, somebody somewhere was selling US bonds. Maybe China. And maybe that's the reason why Donald Trump blinked this week and had that 90-day hiatus in imposing those particular tariffs, except, of course, on China. Trying to work out the politics and the mood of a president who uses his social media platform to make key decisions and even to give stock tips is highly unorthodox. But this is all something that investors, big and small, have to adjust and adapt to. So quickly, let's just take a look at the Aussie stock market this week. On Monday, the share market had one of its biggest one-day falls ever since 2020. A day later, as tariffs were deferred, one of its biggest rises in history. On Friday, another big fall. Overall, our market, you can see it here, was just down by 0.5%. In other words, pretty good under the circumstances. Now, the big moves, though, would have rattled investors' confidence. And the biggest investor in Australia is the superannuation fund Australian Super, which has $365 billion in funds on behalf of 3.5 million members. So on such a volatile week, I thought it'd be good to catch up with Alistair Baker, who's the head of asset allocation at Australian Super, just to see how it navigates these moments of enormous change.
We certainly encourage our members to have a very long-term approach. In terms of, the markets have ups and downs. A crisis occurs where you might have a 20% drawdown in equity markets once every 2 to 3 years, and recessions happen on average every 6 to 7 years. So our investment processes are designed to have regard to the fact they occur, but we certainly encourage our members to focus on the long term. Certainly, as we've seen in the last few days, there can be quite violent moves in markets. And it's important to be invested at each time, not to switch and react to markets, because if I can use an example, Wednesday we had a very large move in share markets after an announcement. And that return was about likely 6%, maybe 6 to 7% return for the average super member on that single day. So if you weren't invested on that day, you've missed out on almost an entire year's average return on your super.
So the trick is there to be there for the long term. I get that. But then you would excuse your members for being a bit nervous, and especially those who are coming towards their retirement years who need to know what they've got in the bank account. Now, do you take any account into this when you're investing, or is it a case at that level of the person being pretty much on their own in terms of what they end up with in their superannuation pot?
Well, I don't think anyone needs to be on their own, Ross. You can consult financial advice, and we certainly encourage people, if they have concern, to consult a financial advisor. I guess the way I think about it for a lot of members is that if you use the analogy of a bubble, most bubbles create, and we talk about stock market bubbles, most bubbles pop when there's too much air in them. And in many cases, downturns in share markets are usually preceded by a run-up. And this one's no different. If you look at US equity markets, and in particular the Magnificent Seven, they have had a substantial performance outcome over the last 2 to 3 years. So for many members that have been invested over the course of the last few years, they've seen a good rise in their balance. And yes, of course, there has been a slight decline in the last 2 months, but over the long run, they've been benefiting from the boom. And when busts occur, in most cases, they are handing back some of those gains, but quite a lot of those gains still tend to accrue in their accounts.
All right, so of those 3.5 million members, and you've got from July 1 this year, 12% of their pay coming into your fund literally on a weekly, monthly basis. So the fact of the matter is you have significant amounts of cash that continue to come through the door. So in terms of your asset allocation, do you seek to change your exposure to equities when things get volatile, or do you try and stay the course regardless of what the equities markets are like?
So the broad answer is it depends, because it partly depends on how we see the economic outlook. But But absolutely, the underlying point is that dollar cost averaging is something that people hear about when they might talk to a financial advisor. And as a fund, we do apply a lot of that methodology ourselves. So progressively investing over time improves the compounding of returns. In this particular example of the recent weakness in share markets, we would say that if too much bad news is in the price, then it might be a better buying opportunity and an opportunity to add more to exposures. What we have to do is counterpoint that with what's going on with the economic outlook. So the potential for tariffs does have the ability to reduce economic growth, and that will have an impact on corporate earnings. So there's a bit of a balancing act between what you might call value, or what we're paying for an investment, and outlook being, what is the outlook for growth in economies. So it's a balancing act we judge whenever we're faced with a difficult market. In this particular case, we've got cheaper prices, but also a slightly weaker outlook.
Yeah, okay, so slightly weaker outlook. So I want to talk to you about that as well, because given the fact you've got the best part of $360 billion in that fund, it's pretty hard for you to change the dial. So even if you go and start to buy with the spare cash reserves you've got, chasing bargains as it were, try to change the dial in terms of your overall returns, given the fact that the funds are so large, that makes a difference for you as well.
Well, it can a little bit, but I draw a distinction here. So for a professional investor like ourselves, in terms of how we look after members' assets, buying individual stocks is something we manage carefully around looking for specific opportunities. But in my team, who runs the fund's asset allocation, we will tend to make investment decisions and go into the futures market. So there's considerable depth in global futures markets if we want to buy equities or allocate to fixed income. So short-term decisions can be implemented with a fair bit of depth and market liquidity. And then individual investment opportunities will be undertaken by other parts of our investment team, whether that's in Australian equities or the global equity market or infrastructure projects or the like.
I'll tell you what, it's really instructive, Alistair, because it gives us a sense as to how our biggest retirement fund actually manages the volatility of the markets these days. Many thanks for your time.
Thank you, Ross. It's been good to be here.